Good morning, everybody. Welcome to another day of Market Report brought to you by Mike Bjork. Today is Friday, and it's June 24th, and we got a lot of big news to go over today, especially the one biggie we discussed yesterday. So let's go right into it. But first, we're going to jump right into the economic calendar. We got the durable goods orders for the month of May. So back in April, we had a nice increase at 3.3%. May was supposed to contract at negative 0.6%, and it came in at negative 2.2%. So obviously not good news there. Now, when you strip out the big ticket items like airplanes and stuff like that, we got what they call the core capital goods orders. These are more the what we buy in our normal everyday lives and stuff. And back in April, we also had a negative 0.4%, and May it increased further at another negative 0.7%. So not so good on there. Seems to be pulling back a little bit. So it'll be interesting to see what the GDP will look like with these type of numbers here for second quarter here. We also got consumer sentiment, so this just kind of gives us the mood of where the consumers are at. And to be frank, I think probably a lot of people are just getting kind of tired of the whole election process and such. So this is probably what we're seeing a result of. So you can see here at 94.7 back in May, we had or the previous report was 94.7, and it was supposed to come down a little bit to 94, and actually worsened it to 93.5. So not really good numbers here overall for data here. But the one data that's going to supersede all this is these Brexit results. Stock market is way down. It opened up like Dow is down like over 500 so far this morning. This is being kind of treated almost like the '08 financial meltdown is what it's kind of be treating. A lot of panic, a lot of worry on the market. It came in as a complete surprise. So people in London, when they woke up, were shocked. Is what's being that they're leaving the European community. It came in at like a 51.9% true exit. So early results were showing that it looked like they were going to stay. So a lot of people were a little bit more comfortable yesterday. Last 2 days, a lot of polls were showing that they would remain, that they're looking pretty good. But I guess that just tells you that you can't really always rely on these polls, especially when it's this close, when you're talking about 52% to 48%, basically. So anyways, a lot to be determined as to what's going to happen next. They're trying to obviously ensure their exit. A lot of things have been, the oil price went down. The pound sterling is taking a big hit. One of the biggest drops in history for the pound and the value of it. It was down like $1.32. Now it's kind of ranging around 137. So we haven't really seen that in quite that type of currency exchange for a while. So basically, currencies that are actually doing well are the U.S. and Japanese yen. So a lot of people are putting money into there. So the stock market's taking a big beating on a global level. Some of the questions that this result will raise is what other countries could be next. England was a pretty big. We saw what happened with Greece, and that's just a country that, if anything, they're kind of they're not really contributing to the European community, but more taking, so to speak. And Europe, Great Britain was a big part of that. They're one of the financial centers over there, and they're going to be sorely missed from the European community. And that could lead to other countries potentially leaving. You got to look at countries like Italy. You got to look at Spain, Portugal. Some of those countries could be exiting, and so probably long term, what will happen is they'll probably lose a few countries, and probably even remove, even countries that may not want to be there may actually have to cast them out because maybe they're bringing the whole community down and maybe not contributing enough that it might revise their system there. And of course, this is more for economic purposes mostly. So we'll have to kind of wait and see, shake it out. But this could drag on for a while as to, because nobody knows exactly what's going to happen. And right now, investors are panicking. And as a result, this is actually helping out bond market. So because they're panicking, as we saw even with the Great Britain, or with the Greek, we had some nice rallies there. Look at this. We left off here about basically at zero. We actually had a late rally and ended up at zero. So we were down for most of the day around 6 to 12 basis points, and even touching off the second resistance here, but kind of starting the day at the 25-day moving average and rose above it. And today, right now, we're actually up we're currently at about 50 basis points higher. So almost blowing basically above the second another resistance here. So this is the resistance here, and we're actually blowing above this. We were here for about 1 day, this level in February, about 1 day, and then it quickly dropped. This, I think, is going to sustain itself for a little while. We may close this gap because this is a pretty big gap at one point, but I think you're going to see this rise above and stay up this way for a little while. The last time we saw this was nearly 2 years or a year and a half ago, right around November and January of 14-15, and that was about the last time we were at this level. And so kind of expect this type of rates being priced out right now. So this is a good time if you're, if you want to look at refinance, this is a good time to maybe look at right now as well. As I think we're going to see rates going forward. Concerns now is that we could have a global recession. What's going on out there? A lot of economists, even before this vote, were saying that they see a recession coming within the next 12 months. So, especially with the jobs numbers not looking as good as they thought, and some of the things that were coming out weren't looking as well, and it's just moving so slowly that they think there might be not growing enough that might kind of stall things a little bit. So, and if we go into a recession, what typically happens is that we get better interest rates as a result, because instead of the Fed raising rates, they're usually cutting rates to try to stimulate the growth. So, for definitely July, they're going to take out the rate hike off the table, and we may not hear talk of one perhaps this year as a result of this Brexit, because this is going to drag on for a while here. Sorry for the long thing here, but great day for bonds, for interest rates. Terrible for equity markets, as we'll probably see a plunge there, and the bond market will take advantage of it. Have a great weekend. Thanks for watching, and we'll see you guys on Monday. Bye.